Welcome to EPG Pathshala. This is Dr. Ankush Ambardar from Kurukshetra University, Kurukshetra. Today, I'll be taking up a topic from the subject Tourism and Hospitality from Front Office Operations and Management, and the topic is Foreign Exchange Procedure. Well, after completing this unit, the students will be able to understand the foreign exchange procedure, will be able to know the structure of Forex, parameters of residential status of under FEMA, functioning of Forex in hotels. Well, Forex is a system in which currency of one country is exchanged with another, which enables international transactions to take place. In tourism industry, when a foreign tourist spends even $1, that is considered as a foreign exchange earning for the country. Exchange regulations play an important role in Indian economy. Foreign exchange controls were introduced in India during the Second World War in 1942. After independence, FERA, Foreign Exchange Regulation Act 1949, was formed formally, which was followed by FERA in 1973. FERA, Foreign Exchange Regulation Act to FEMA, Foreign Exchange Management Act. In 1970s and 1980s, due to large external sector imbalance by increase in adverse balance of payments situations, dependence on official foreign aid increased, which triggered the wave of economic liberalization. The Indian rupee became market determined in 1993. The need was felt to change and consolidate the law related with foreign exchange to facilitate external trade, payments, and to promote the development and maintenance of foreign exchange market in India. FERA, Foreign Exchange Regulation Act 1973, transformed into FEMA, Foreign Exchange Management Act 99 on June 1, 2000. FEMA was created with the objective to facilitate external trade payments and to promote the development and maintenance of foreign exchange market in India. Structure of FEMA. In India, exchange controls includes basic legislation, FEMA 99, and rules, circulars and notifications issued by RBI, Reserve Bank of India, which is known as Authorized Persons Directions, AP, Direct Series. Foreign Exchange Management Act is applicable to all offices, branches and agencies in India which are controlled by resident in India. Capital account transaction and current account transaction. India accepted Article 8 of the Articles of Agreement of International Monetary Fund in August 1994. India became fully convertible on the current account transactions. All current account transactions are allowed through the normal banking channels. In case of capital account transactions, only the transactions which are explicitly enabled under the guidelines are allowed, remaining require specific approvals under FEMA. Accordingly, it is very important to understand the concept of capital and current account transactions to comprehend FEMA. First, capital account transactions. Capital account transaction is defined under Section 2E of FEMA as a transaction which alters the assets or liabilities, including contingent liabilities outside India of persons resident in India, or assets or liabilities in India of persons resident outside India, and includes transactions referred to in subsection 3 of Section 6. So, any transaction as a result of which the assets or liabilities outside India of a person who is resident in India and assets or liabilities in India of a person who is resident outside India are altered, that is, either increased or decreased, is a capital account transaction. For example, if a person resident in India acquires shares of a foreign company, her overseas assets will increase. Similarly, if a person resident in India borrows from a non-resident through external commercial borrowing, ECB, her liability is created outside India. Hence, both the transactions lead to creation of assets or liability outside India of a person resident in India. Both the transactions are capital account transactions. In case of a person resident outside India, if she acquires shares of an Indian company, her assets is created in India, and if same person borrows from an institution in India for acquiring house in India, his liability will be created in India. Both these transactions lead to creation of assets or liabilities in India of a person resident outside India. Hence, both the transactions are capital account transactions. The concept of capital and current account transaction is to be seen from balance of payment point of view. If after the completion of transaction there remains any obligation to either pay or receive foreign exchange, the transaction would get color of capital account transaction. For example, import of plant and machinery is a current account transaction, as upon import the machinery is received in India and overseas suppliers is paid within 6 months from import, and accordingly there is no future obligation on India as a country to honor foreign exchange obligations. In this example, from accounting perspective, though plant and machinery would be capital goods, but for FEMA it would be a current account transaction. Prohibited capital account transactions. Now, general prohibitions. A person shall not undertake or sell or draw foreign exchange to or from an authorized person for any capital account transactions other than those permitted in the schedules, provided the transaction is within the limit. Special prohibition. No person resident outside India shall make investment in India in any form, in any company or partnership, firm or proprietary concern or any entity, whether incorporated or not, which is engaged or proposes to engage in the business of chit fund or in agriculture or plantation activities or in real estate businesses or construction of farmhouses or in trading in transferable development rights (TDRs). Real estate shall not include development of townships, construction of residential, commercial premises, roads or bridges. Current account transaction. Current account transaction is defined under Section 2J of FEMA to mean a transaction other than a capital account transaction and without prejudice to generality of the foregoing. Such transaction includes payments due in connection with foreign trade, other current businesses, services, and short-term banking and credit facilities in the ordinary course of business. Payments due as interest on loans and as net income from investments. Remittance for living expense of parent, spouse, and children residing abroad, and expenses in connection with foreign travel, education, and medical care of parents, spouse, and children. All current account transactions are generally permitted unless specifically prohibited, whereas all capital account transactions are generally prohibited unless specifically permitted. Current account transactions are divided into 3 schedules in current account transaction rules. Schedule 1, prohibited transaction. Schedule 2, transaction requiring prior approval of Government of India, and Schedule 3, transactions requiring prior approval of Reserve Bank of India. Examples to understand capital and current account transactions. Let's take an example. So, import of machinery on hire purchase. In this transaction, the person has created future obligation for making payment to non-resident and hence has liability towards the non-resident. Therefore, the said transaction is a capital account transaction. Transaction representing creation or acquisition of wealth, shares, loans, or immovable properties. Since such types of transactions would lead to creation of assets in or outside India by person resident outside or in India, as the case may be, the same are in the nature of capital account transactions. Remittance out of winning from lottery. This comes under prohibited list Schedule 1 of the current account transaction. Hence, although same is the nature of current account, such transactions are prohibited. However, an entity engaged in lottery business imports any software or machinery to be utilized in lottery business in India, the same is a permissible transaction. Import of software or machinery will not result in violation of FEMA regulations in relation to current account transactions. But any type of technical collaboration for lottery business, including licensing for franchise, trademark, brand name, management contract, or any contract for payment of royalty as such for such collaborations is prohibited under both current account transactions rules and also under FDI policy. Hence, such transactions are not permissible. Options premium payable under NASDAQ. Options premium is the price paid by a person to buy an option contract, whether it is a call or put. So option premium is paid to acquire only specified rights for a contract. Under option contract, there is no future obligation in addition to optimum premium paid at the time of entering into contract, so it does not result into creation of any contingent liability and hence is a current account transaction, whereas future contract would be capital account transaction. Option contract may result into creation of contingent assets and subcontingent assets is not covered in the definition of capital account transaction. Opening a branch outside India. Opening a branch outside India is a current account transaction as it does not result into alteration of any assets and liabilities overseas. Since overseas branch would be regarded as resident of India, if however such overseas branch proposes to acquire immovable property, say office premises outside India, such acquisition would be regarded as capital account transactions. Residential status under FEMA. Under FEMA, residential status is of two types, that is person resident in India and person resident outside India. In FERA, citizenship was considered as the deciding factor. However, FEMA lays emphasis on residing, which denotes permanency. Persons resident in India means a person residing in India for more than 182 days during the course of preceding financial year, but does not include a person who has gone out of India or who stays outside India in either case, for or on taking up employment outside India or for carrying on outside India a business or vocation outside India, or for any purpose in such circumstances as would indicate his intention to stay outside India for an uncertain period. Next, a person who has come or stays in India in either case otherwise than for or on taking up employment in India or for carrying on in India a business or vocation in India, or for any other purpose in such circumstances as would indicate his intention to stay in India for an uncertain period. Any person or body corporate registered or incorporated in India, an office, branch or agency in India owned or controlled by a person resident outside India, an office, branch or agency outside India owned or controlled by a person resident in India. Person resident outside India means a person who is not resident in India. Section 2W FEMA is a regulatory law and therefore, unlike Income Tax Act, which looks at only condition of number of days stay in or outside India to determine residential status for determining tax liability at the end of previous year, FEMA lays more emphasis on intention purpose of leaving India or coming to India. Say for example, a person has left India on 1st of February for employment. In this case, even though the person has stayed for more than 182 days in India in preceding financial year, but his intention going abroad was for employment. So, immediately from the day he leaves India, he will be treated as a person resident outside India or non-resident under FEMA. Taking the above example forward, now since the person becomes resident outside India, he can immediately open a foreign currency account outside India, which otherwise would not have been possible if he was treated as person resident in India. Hence, while referring to the residential status of a person, his purpose or intention matters the most. Dealing in foreign exchange. Section 3 contains very important provisions and it has 4 subsections which are explained thereunder. No person shall save as otherwise provide, deal in or transfer any foreign exchange or foreign security to any person not being an authorized person. The word deal in is a wide term and should include purchase, acquire, borrow, sell or otherwise transfer or lend or to exchange with. The intention here is to regulate dealings in foreign exchange through authorized persons such as banks, money changers, etc. The transactions of foreign exchange resulting in earnings or spending must be routed through authorized persons except where specifically provided. Contravention of Section 3 is a very serious offence and it cannot be compounded by RBI but has to be referred to Enforcement Directorate. No person shall make any payment to or for credit of any person resident outside India, NRI, in any manner. This provision is highly restrictive and debars residents for making any payment to or for the credit of any person resident outside India in any manner. This led to practical difficulties such as when an NRI visits India to meet his relatives, even his close relatives cannot offer hospitality to him, or such NRI cannot be given gift in Indian rupees in India. Realizing the practical difficulty and to waive to provide relaxation, a notification allowing a resident individual to make a gift or grant loan to an NRI who is close relative in rupees of a way of cross-check electronic transfer to NRO account. Close relative shall have the same meaning as that of relative under the Companies Act 1956, and the amount so paid shall be within the permissible limit specified in liberalized remittance scheme. No person shall receive otherwise through an authorized dealer any payment by order or on behalf of any NR in any manner. Explanation. Where any person in or resident in India receives any payment by order or on behalf of any person resident outside India through any other person including an authorized person without corresponding inward remittance from any place outside India, then such persons shall be deemed to have received such payment otherwise than through an authorized person. No person shall enter into any financial transaction in India as consideration for in association with acquisition or creation or transfer of a right to acquire any asset outside India by any person. Explanation. Financial transactions means making any payment to or for the credit of any person or receiving any payment for by order or on behalf of any person or drawing, issuing or negotiating any bill of exchange or promissory note or transferring any security or acknowledging any debt. As per notification number 17 dated May 2000 of FEMA, the above clause shall not apply to any transaction entered in Indian rupees by or with a person who is a citizen of India, Nepal or Bhutan, resident in Nepal or Bhutan, or a branch situated in Nepal or Bhutan of any business carried on by a company or a corporation incorporated in any of three nations, or a branch situated in Nepal or Bhutan of any business carried on as partnership or otherwise by a citizen of any of three nations. Foreign exchange procedure in hotels. The first work for a hotel authority to attain a license to exchange foreign currency. Without being authorized to deal with foreign exchange transactions, a hotel cannot exchange foreign currency. So, a hotel has to be licensed for the front officer, cashier, to deal with the guest in this regard. The rate of exchange should be exhibited considerably. Central banks governs the rate and updates its daily basis system. Government monitors all foreign currency that extended by hotels. For the exchange of foreign currency in hotels, the authority has to maintain some rule that are fixed by the central banks. The rules as follows. Firstly, a hotel has to obtain a license from the government to exchange foreign currency. License will be for the personnel, not for the whole member of a hotel or in favor of the specific hotel. Generally, license goes to the front officer or the cashier. Only local currency is exchanged in favor of the hotel guest. So, the front office should have knowledge about the system before going to exchange for the favor of his guest. Central bank governs the exchange rate. Daily basis update rate is strictly followed in the exchange desk. So, the cashier can't demand other rate in favor, disfavor his guest. To exchange the money, cashier will ask the guest for his or her identification from passport and will verify the date of issue, place of issue of the passport and its expiry date of the passport. He will also confirm the guest status, resident or not. If the guest is resident, only then the front officer will advance for exchanging the money. For the non-resident guest, the cashier will direct the guest to the lobby manager. The lobby manager can give the authorization of exchanging money for the VIPs or the regular guests. If all things go right, then the cashier will receive the cash in dollars, pounds, sterling, euros, yen, etc., or even through traveler checks. It should be filled out the details in the foreign exchange encashment certificates. The foreign encashment exchange certificates come in seriously numbered book for the better control. The hotel cashier will request the guest to sign the travel check, the same that the guest signed before the bank cashier. Then the cashier will request the guest to sign the foreign exchange encashment certificate matching to the passport's signature. Then the guest will get his/her total money in local currency what is exchanged by the cashier. The cashier has to affix a copy of the foreign currency encashment certificate to the travel check. He has to keep the record of the exchange. Currency exchange receipt formats and procedures in hotels. Foreign currency exchange and traveler's check exchange is a facility offered to their guests by the hotels. Usually, hotels have tie-up with authorized currency exchange dealers like Thomas Cook, etc., and do the exchange on their behalf after procuring license for the same. These dealers send currency exchange rates to the hotels on a daily basis, which is updated on their software and also displayed on the cashier's desk. Some hotels provide this facility only for in-house guests. This can also depend upon the government regulations on that particular region where the hotel is located. Hotel may also charge a commission percentage on top of the normal exchange rate as a fee to service provided to the guests. To conclude with, to learn FEMA, the clarity on the concept of capital and current account transaction is of paramount importance. Capital account transactions still being regulated, there is a need for professionals who could provide services in FEMA. In hotels, the foreign currency exchange being one side, meaning that the hotels are liable to accept the currency and not to give the change to foreigners in transactions during the stay in the hotels. Hotels have either a branch section to deal with the same, or the front office cashiers have to be trained to deal with such transactions. Thank you for watching EPG Pathshala. This was Dr. Ankush Shambardar from Kurukshetra University.